Your high IQ is currently the single greatest liability in your portfolio. You are likely broke precisely because you are smart. While you are busy analyzing the yield curve, decoding the macro cycle, and reading white papers on emerging markets, someone with an IQ of 100 just bought the index, went to sleep, and outperformed you by 40%. You treat the market like a puzzle to be solved. The market treats you like a calorie to be consumed. You are trapped in a loop. The smarter you are, the better you are at rationalizing your own hesitation. You have built a sophisticated mental prison where you convince yourself that research is progress. It is not. It is procrastination wearing a tuxedo. Look, if you're tired of being the smartest person in the room with the smallest brokerage account, pay attention. My name is Zoe, and here at Exponential Mind, we don't just count pennies, we rewire how you think about wealth. If you're someone who analyzes every decision until it dies on the operating table, make sure to hit the subscribe button. Today, we are dismantling the intelligence trap. I am going to show you the specific cognitive malfunctions that punish high IQ individuals in the financial markets. We will look at the math of overthinking and the cost of your ego. Warning, I am not here to make you feel good about your intellect. I am here to make you rich. They are often mutually exclusive. Let's start with your brain's favorite drug, pattern recognition. In evolution, pattern recognition saved your life. You saw a rustle in the grass, you recognized predator, you ran. You survived. But in the market, this same mechanism gets you slaughtered. Smart people are obsessed with finding order in chaos. You look at a stock chart and you see a head and shoulders pattern. You see a Fibonacci retracement. You see logic. Here is the brutal truth. Most of the market is random noise. You are looking at white noise and seeing a symphony because your brain cannot accept that the system is chaotic. This is called the narrative fallacy. You buy a stock, it goes up. You tell yourself, I was right because of my analysis. You buy a stock, it goes down. You tell yourself, the market is irrational right now. Look at these two charts. One is Apple in 2010. The other was generated by a random number generator I ran this morning. You cannot tell the difference. And because you can't, you invent a story. Oh, that dip? That was market manipulation. No, it was randomness. Smart people lose money because they bet on patterns that do not exist. You are trading against hallucinations. This leads us to the second mechanism keeping you poor, complexity bias. If I put two buttons in front of you, button A, press once a month, get 8% returns. Button B, solve a calculus problem, adjust 40 levers, analyze 10 spreadsheets, get 8% returns. You will pick button B every single time. Why? Because button A feels too easy. You feel your intelligence is being wasted. You don't want money, you want validation. Let's run the numbers on the ego tax. Take investor A, the genius. He constructs a perfect portfolio, 15 uncorrelated asset classes, alternative investments, short strategies. Because of the complexity, he pays higher expense ratios, trading fees, and, crucially, taxes. Let's say his total friction cost is 1.5% annually. Take investor B, the idiot. She buys a total market index fund, cost 0.03% annually. Let's assume the market gives them both a gross return of 8%. Over 30 years on a $100,000 investment, the idiot ends up with $998,000. The genius ends up with $661,000. Do you see that? That gap is $337,000. That is not market volatility. That is the price of your need to feel sophisticated. You paid $300,000 for the privilege of feeling smart. Complexity is the ego's favorite hiding place. In finance, simplicity is the ultimate sophistication. If your strategy takes more than one page to explain, you are not investing, you are just masturbating your intellect. Trap number 3. This is the one that kills the beginners. Analysis paralysis. I see you in the comments. Is now a good time to enter? Should I wait for the election? What if the Fed hikes rates? You are waiting for perfect conditions. You think you need 100% of the information to make a move. Let me be clear. If you wait for 100% of the information, you are already too late. The profit is in the uncertainty. Let's look at the cost of waiting math. This should terrify you. Scenario 1. You start today. You invest $500 a month, 8% return. In 30 years, you have $745,000. Scenario 2. You are smart. You wait 5 years. You want to study the market. You want to master it. To get that same $745,000 in the remaining 25 years, you don't need $500 a month. You now need $850 a month. You have to work almost twice as hard just to end up in the same place. But it gets worse. What if you think you can time the market? Data from Schwab shows that even if you had perfect timing, literally buying at the absolute lowest point every single year for 20 years, you would only outperform the person who just bought immediately by a tiny margin. And you do not have perfect timing. You have anxiety. So you sit in cash. And while you sit in cash, inflation eats your savings alive. Inaction is an action. It is a short position on your own future. Finally, we have the most painful realization. The smart money usually loses. We have this idea that Wall Street is full of geniuses who know something we don't. This is the SPIVA scorecard. It measures active fund managers against the boring S&P 500 index. Over a 15-year period, 92% of professional managers failed to beat the market. These people have PhDs from MIT. They have algorithms you can't even comprehend, and they lose. Why? Because the market is an efficient information processing machine. It prices in news faster than you can read the headline. If a team of 50 quants with a supercomputer cannot find an edge, what makes you think you can find one reading Yahoo Finance on your lunch break? You aren't the casino. You are the drunk tourist trying to count cards. The dumb investor wins because they respect the math. The smart investor loses because they respect their own opinion. So how do we escape the intelligence trap? We have to lobotomize your financial decision-making process. We need to remove you from the equation. Here is the Null-Hypothesis protocol. Step 1, the boring default. Accept that you are average. Move 90% of your capital into low-cost, broad market index funds. Set it to auto-invest. Make it invisible. If you have to log in to invest, you have already failed. Step 2, the 5% sandbox. I know you have an ego. I know you need to gamble. So take 5% of your portfolio. Put it in a separate account. This is your play money. Buy crypto, buy Tesla, short the yen, do whatever you want. But here's the rule. You never add money to the sandbox. If you lose it, the game is over. This traps your ego in a small box where it can't hurt your real wealth. Step 3, the information diet. Stop watching financial news. CNBC, Bloomberg, YouTube gurus, they are not selling financial advice. They are selling anxiety. Anxiety sells ads. Anxiety triggers cortisol. Cortisol makes you sell at the bottom. Turn it off. Boredom is the highest returning asset class. If your investing is exciting, you are doing it wrong. Real wealth is watched like paint drying. I know this video annoyed you. I know part of you is screaming, but I'm different. That voice? That is the voice that keeps you broke. Real intelligence isn't about complexity. Real intelligence is recognizing your own limitations and building a system that works in spite of them. You have two choices today. You can keep trying to be right, or you can decide to be rich. You cannot be both. Discipline is the real IQ of money. I'm Zoe, and see you in the next one.